Peter Eliades with you. This is the Stock Market Cycles update for the week ending Friday, February 14th. Hope everyone enjoyed Valentine's Day. Sometimes people say to me, why are you giving all your work away? You must do hundreds, if not thousands of hours of research. And it's true, I do. And I mean, over the years, if you go back to the beginning of my career, we're talking about thousands and thousands of hours of research. If you figure I'm looking at these charts 4 hours a day and there are 252 trading days in a year, assuming I don't look at them Saturdays and Sundays, which is not true. I mean, there's 1,000 hours each year right there. You want to go back to the late 1960s and early 1970s when I began in this business, and you've got tens of thousands of hours of, because I love it. That's why I do it. I love it. I'm fascinated by it. So let me tell you ahead of time, this is going to be a long update. I'm going to go through a lot of things. If you're not really fascinated by cycles and technicals in the market, you'd probably be bored to tears. If you are in love with cycles and the technical aspect of the market, as am I, then you might well be fascinated. So fasten your seatbelts. We're going to go over a lot of stuff today because we're coming into a time zone now that becomes more and more important here in 2020. Okay, this chart that I'm showing you now is something that I did over the past year from research that I did quite a while ago. I discovered quite a while ago that there are several time spans of 150 months, that's 12 years and 6 months, 12 and a half years, from important turning points in the market. Now, I first started looking at only 150 months, and some of them were so close to that I said, let's be a little flexible. So what you're looking at now is red lines, green lines, and dark blue lines. The red lines show time spans between 149 and 151 months. So anywhere you see a red line connecting a high or a low with a high or a low, that's 149 to 151 months. The green lines are slightly shorter, 146 to 148 months, and the dark blue lines are the longer ones, 152 to 154. But all in all these lines encompass time spans between 146 on the shortest side to 154 on the longest side. And you can see how they connect some of the most important turns in market history. Here's the 29 high. That comes down to the 42 low, and that's within the span of 149 to 151 weeks. But look at virtually any 2 points that are connected with lines with each other. For example, here's another one. This is the 62 low out to the 74 low. Again, 12 and a half years. That one, because it's a red line, is between 149 and 151 months. So as you probably noticed, this chart that you're looking at only goes through 1995. Let's look at the most recent time spans, okay? So here we go with the most recent ones. Same thing throughout market history. Look at this. From the 62 low, I think we just showed that one, to the 74 low. From the 82 low, green line goes up to the 94 bottom before the explosion. It wasn't what you call any kind of big decline into this low, but look what happened afterwards. So that goes on and on. This one looks like a long line right here. It's just a combination of two 12 and a half year periods. This is from the 87 high to the 97, 99, 1000 to the 2000 high. Okay? So I wanted to show this to you to show how many segments there have been in the market connecting these 150-month or 12 and a half year segments. And now I want to show you the last 3 or 4 of them so we can attempt to read a little more insight into them. So if we go back to May of 1970, that's where we see these dashed lines, dashed vertical lines. This is the low in May of 70. And these dashed vertical lines, look at the time spans between them. From May of 70 to the very important low in August of 82 was 147 months. From the August of 82 low to the bottom in December of 94, just before the explosive move to the upside, 148 months. From that 94 low to, at this time I went to the July high because it fits a little better. And if you say, well, the high wasn't in July, it was in October of 2007, you're correct. You know what the difference was between the two? 1.25% on both the S&P and the Dow, and perhaps more importantly, the high for the secondary stocks, Value Line Composite Index, the Russell 2000, they topped in July of 2007. So this is a legitimate count. From that low in December of 94, coming into the high of what I call July of 07. So you go December and add 7 months onto the 144, which is 12 years, and you come up with 151 months. And that's this time segment right here. So you have 147, 148, and 151. Okay, from that July high to this month, February, is 151 months. Okay? Now, there are no guarantees in this business. Nothing says you have to be at an important turning point. We're just showing probabilities and possibilities now. So if this goes all the way back to 1970, you're talking about 50 years, 4 of these 12-and-a-half-year cycles. And we're starting to show in this time zone where there could well be a resolution. February is kind of idealized, but if you start from October and go out 150 months, it carries you into April. So we're in that time zone right now where we could be looking for the possibility of a very major market turn. I can't conceive that now that we're at new all-time highs, that a turn would be some kind of low. So we're calling it the possibility of a very important market high. This is the one we wanted to look at to show that 150-month cycle. Now, I'm going to show you a chart that we showed in our last report, and towards the end of January, that we told you at the time would not be fair to show all of you at the time because people paid to see that with the report that I put out. But I'm going to show it to you now. This is fascinating. Not very clear. I wish it were a clearer chart, but that's the best I can do, and I think you can make it out, okay? Here's a pattern I discovered quite by accident. And here's how I discovered it in looking at this long-term chart. A lot of you probably have never seen a chart that goes back this long with security prices. This is monthly chart of U.S. security prices back to 1789. That's back here, folks, at the beginning of the chart. So what I noticed when I looked at this a month or two ago as I was starting to write a report based on something completely different, based on these time patterns that go 33 years and several months. That's another one. We're not going to talk about that one today, but that's where I came upon this pattern. So through this whole chart, which goes back 230 years just about, there are two very obvious significant declines. The first one ends at A, and the second one goes from B to C. So you have a market move from this significant low at A to this very important high at B. That happens to be the September 1929 high before the market crash. And then you had this significant decline. As we write down here, we ask you to glance at the chart. It could be easy to pick out the two declines that end at the red A and C. The decline into A was 76.2%. The decline, the crash into C, was almost 90%. The two largest equity declines in the 230-year approximate history of the United States securities markets. So I looked at that and I said, this looks pretty interesting. After that huge decline into the bottom at A, how long did this period last that took us to another important top, or to one of the most important tops in history that led to the largest decline in history? It actually ran 87 years and 6 months from this bottom to this top in 29. And then I said, this time span looks a heck of a lot like this time span from the July of 32 low. And guess what? It was 87 years and 6 months from this low at A to the high in 1929 at B. If you measure forward another 87 years and 6 months from this July of 32 low, it takes you to January 2020. We're a couple of weeks beyond that now, but look where we are in terms of this pattern. Now, this is not a pattern that's gone on for hundreds and hundreds of years. There's only been one prior example of it. So to say that that means this is going to be significant is begging the question somewhat. I mean, there is no indication whatsoever that because this was 87 years and 6 months, we're going to reach a fantastically important bottom at the end of this move at 87 years and 6 months, plus or minus. But it's a pattern that fascinated the bejeepers out of me, and I wanted to show it to you. So from this low, the first great decline in market history to the first great top in market history in September of 29 is the same distance as the bottom in 1932, one of the worst declines in market history, to where we are right now. January, February, give or take a month or two, 87 years and 6 months, or 87 and a half years. Okay, let's go to the projections. We're going to do a quick review of the projections now. A very important chart. We showed you this. We've had this projection, by the way, this one in the green box, green rectangle, going back to February, March, April of 2019, okay? That's how long it was around, and that's what we kept pointing for. Now, we reached, or almost reached, the lower part of that box in late November of 2019, of last year. Came back down and finally reached it fully in December. But when we reached it in December, neither the New York Composite Index nor the Dow Jones Industrial had reached into their equivalent projection box. They finally did that as this on the S&P reached the upper side of its projection, which was 33.31.11. In fact, it reached it almost exactly and precisely with a high on January 22nd of 33.37.77. It's within, what, 1/10 of a percent. Very, very close to the very upper side. So we started talking to you at that time about loop projections, which simply means that prices come down from there because they have no higher to go projection-wise, and create a little loop, a loop down and up. And as they do that, they possibly give higher projections. If indeed those higher projections occur, and you'll see that when we show them to you on another chart here, those are loop projections that can lead to higher projections, okay? So in order to look at possible loops, you start with the shortest term daily projections. And this is the shortest one. You see, here's the high, that 33.37.77 high. It came down and looped back up, and as it did that, it gave a projection up to 33.40 to 50. So that was the first loop projection that was given. The next loop projection was given. The next longer offset was 7 to 8 trading days for a nominal 20-day projection. We just met that fully, the lower side of it, on Thursday of this past week. We told you that. 33.8222, the high that day was 33.8509. So that loop projection was met. Mind you, there's more room, further room on the upside up to 34.06 and change, but on a minimum basis, it was satisfied. So we go to the next longer projection. This is 12.1 to 13.8 day offset that gives a nominal 5-week projection. And that nominal 5-week projection called for 33.5682 to 34.2667. That one was met over the last week. Now, again, remind you, there's the possibility of higher projections here, 34, 26, 67. So, but the point is that we met the nominal 40-week projection, came down and had a couple of loop projections coming back up that have both been met on a minimum basis. That means that on a minimum basis, all possible upside projections have been satisfied on the S&P. We showed you a longer-term upside projection, or I shouldn't say longer-term, but an equivalent projection on the New York Composite for higher numbers. So that suggests that even if we are at some kind of top here, that we might get another loop with the S&P and perhaps the Dow while we go up to meet the New York Composite projection. So now we're going to take a look at the trend line that we showed you. Okay, here's this important trend line on the S&P cash. This is a weekly chart. We've done this line on a daily chart, a weekly chart, a monthly chart. We even went to an hourly, and I, as crazy as I am, went to a 5-minute chart back to the low in 2009 and followed the line on a 5-minute chart. I like to do those micro things because sometimes it's just incredible what they show you. Another little discovery this week, instead of using the '09 bottom and going through the 2018 top, which is the line we showed you the other day, what we did was we hunted this line for other possible initial points here, should we say anchor number 1 points, rather than the low in 2009. Was there a high in this area that gave us another potential anchor point? And indeed there was. And let's show you what the result of that was. There's a high here in late March of 2012. I think that's where we started the line. Yeah, late March of 2012. You say, well, why didn't you go to the next bar, which was a little bit higher? And the answer is that we look for external tops. If we zoom really closely into this, you should see that we're using the proper one here because there's a little space here. So this would not be the external high, because this one would have poked above it if you went back another week. So this is the external high, the March 30th of 2012 high. And we connect that to the ending date, the second anchor of January 26th of 18. Now, when you pull back a lot from these, they seem to be exactly overlaid on each other. I'll show you that. You can see they're not overlaid on each other here, but as we pull back on them and go further and further out, it looks like basically the same line. You can see a little bit of red here that delineates the difference. But as you come forward into time, to the present time, look what happens. I'll take you to this week. Here we are this week. Isn't this beautiful? Look what we came up to this week. I'm going to zoom in even further to show you a little bit more. Okay, so the green line was the original one I showed you, which shows you, we'll click on it just to show you the begin date, March 6th of 09, the end date, Jan 26th of 18. This is where it was last week. But look at this second line that I did. This one is begin date of March 30th of 2012 through the high, the same high, Jan 26th of 18. And that one shows a high. I wrote these numbers down. The line this week was at 33.8454. That's exactly where this red line was. The high this week was 33.8509, within 1 point of that. And next week, notice that we close really near these highs at the close of the week. Next week, this line's going to be out at 33.8932. That's the red line. So you can write that one down and look, if we have a little rally on Monday of next week, we might get up one more time to this line. If we start down immediately, we're obviously not going to do that. Okay, now, again, let's go out on this so we can take a look at. This has been an incredible line. I mean, look at it. It hits these lows back here, back in 2010. You finally break it in August of 11. You come up to it and stop, come up to it and stop. All through 2014 and 15, you come up to it and stop. Then you get a nice decline into the 16 low. Once again, you come up to it, and I won't say you stop at the line in January of 18 because the line is defined. The second anchor is a January of 18. So to say that the market at that point, or this line stopped the market at that point, would be cheating because you're using that point to draw the line. But now look at the line and look at how important it's been for the last 10 years, going back to March of 09, and look where we are. Okay? 1 point away at the high this week. Now, remember, there are no guarantees in the stock market. We showed you that line on the New York Composite that we had come up to several times, actually broke above it, and are now comfortably above that line on the New York Composite. So nothing says you won't get above this line on the S&P. If you do, and you'd have to do, I mean, it would have to be not a 5 or 10 point penetration to the upside. That would be what they call in Eliades a throw over of a possible channel or trend line. So that would be insignificant. But if we start getting 1%, 2% above this line in the next couple of weeks, there's something else going on here, and that would have to be viewed as a positive sign, at least for the short term. But for now, we're saying, especially because of the time stuff we showed you, the very long-term time cycles that we showed you, that's why this stuff becomes interesting and important. One more thing to show you. Don't know how many of you work with RSIs. This is a classic RSI. Actually, I was going to say it's a classic, but it's not, because I see now that it's 17 periods rather than 14. 14 is the classic RSI. This one is 17 periods. Let's change it to 14 and see what we come up with. And I like the 17 better, because what you see happening here now is a move well above the 70 level on the RSI. When you see that, that generally tells you, it's a good general rule, that if you're up to where this one is at the high 70s, low 80s, all the way up to 90, that's not going to be a final top. Yes, you're very overbought, but what usually happens is you make some kind of decline, rally back. The ideal situation is you rally back to a new high, as we have done here, as you can see from the weekly bars up here. And at the same time as you're doing that, you come to a significantly lower reading in the RSI. Ideally, it would be a reading right around 70, plus or minus a couple of points. This one is 72 this week on the 14 period. I had the 17 period up there, and it was almost exactly 70. That's why I liked it. But no matter how you look at it, we have the divergence here that we're looking for. So I was going to show you the New York Composite Index, but you must remember that, and I'll show you that at the beginning of next week, because I don't want to make this overly long. But you've got the complete projection and cycle picture here, long-term cycles, projections, how they've been satisfied one by one. I hope you've enjoyed it. Again, this is a labor of love for us, and we know a lot of you appreciate it. We know some of you don't appreciate it, and you're full of criticisms and whatever. So, oh, you've been calling a top for the last 140 years, whatever. We call them, as the projections show them to us. So they're showing us that perhaps we're coming into a zone that's going to be very, very important here. Thanks a lot for watching. It's been a long update. I know we probably lost a lot of you non-cycle and non-technical fans a long time ago. But I hope those of you who are interested in cycles and time spans and technical analysis enjoyed this. And if you did, comment, please let us know. Tell your friends to come and watch this. This is a really important update, I believe. Thank you for watching. If you have not subscribed yet, do so on the bottom right of the screen. And once you subscribe, ring the notification bell. And anytime we do an update, you will be notified. Hope you have a great weekend. We'll talk to you next week.